All right, cool. I have Jorge Abreu on the Capital Raiser Show, man. Welcome. How are you doing today?
I'm doing good. I'm excited to be on the show. Thank you, Ruben.
Man. Yeah, I'm so pumped up, dude. I didn't tell you when I met you at Best Ever Conference, but you totally reminded me of my first real estate partner. You got like the same accent, same physical features. You got the strong arms, and you're all in multifamily. So it's just like the resemblance. It kind of blows my mind, man. But welcome to the show. I'm really excited to talk about multifamily. You're probably the only dude I've ever met that takes down like 1,000 units at a time. That's crazy. So the audience can find out who Jorge Abreu is. Tell us a little bit about your background, man, how you got into multifamily.
I'm originally from South Florida. I now live in Dallas, Fort Worth. But I was going to Florida International University, getting an engineering degree and electrical engineering. And at some point, I realized I really didn't want to be an engineer. It was a little bit late to back out of getting my degree. Plus my mom would have probably killed me, but anyways. So I got the degree, started working for UPS in the engineering department, but at the same time, I started doing some research and looking at other successful individuals and how they built their wealth. And a lot of it led back to real estate investing. So, once I put that together, I really started digging into, okay, so how do I get into this? And I got my real estate license, realtor license. I got my mortgage broker license. Looking back, I didn't really need that stuff. I just didn't know any better. But, it was a good experience. Finally, I got a coach, a real estate investing coach, and I learned how to wholesale and do fix and flips in single family. I started doing that while still working my W-2. And then few deals in, some good paychecks from the real estate investing, I decided to quit my job and just start doing real estate full time. That was about 13 years ago. Went through the Great Recession of 2008, fared okay through it, but did have to make that move to Dallas. Things in South Florida were pretty rough back then. Prices were going down daily.
Yeah.
That led me over to Dallas. And then once I got here, I started doing a lot of fix and flips to the point where for me to scale it, I decided to open a construction company. And that really helped scale and take it to the next level. I was doing maybe 40 to 50 fix and flips plus a bunch of wholesales a year. And maybe about 3.5 years ago, I kind of looked back at everything I had done and it just felt very transactional. And yes, I had made money, but I still hadn't built that wealth that was going to stay, that legacy type money. And that's when I started looking more into multifamily. And we had some construction projects that we were doing at the time with some multifamily syndicators, which before that, I didn't even know what a syndication really was.
Right. And
when they opened my eyes to that and the fact that I can, bring investors together and purchase these large properties, my mind was blown and I went all in. I stopped doing single family altogether. And, since then it's just been all about multifamily. My construction company focuses on multifamily projects as well, our own projects and also investors. And that's it, man. Just continuing to do more deals.
Cool, man. There's so many things I want to talk about that you just mentioned. So the crash, me and my partner, we were taking down properties he lost everything, went bankrupt in San Diego, came over to Phoenix right after, going bankrupt and started taking down multifamilies here, like for $20,000 a unit back right after the crash. I mean, it was such an amazing time, probably very similar to what Florida experienced. And then, so with your construction company, you started out from a single family dwelling and fix it up. And then that grew into something that turned into a full blown development company. Would you consider that a development company, or is it still just like a rehabilitation, like remodeling type of company?
Yeah. So we did do some ground up stuff. We weren't doing anything large scale. The biggest project from the ground up we did was maybe $3 million. But towards the end of last year, we actually ended up merging with a large development company. So we're pretty much the renovation arm, and now we focus on maybe right now we got a couple projects that are 200 plus units. To answer your question, yes and no.
All right, cool. You mentioned something that really struck a chord with me, because a lot of single family fix and flippers, they realize that they're not developing that cash flow, right? So cash flow is king, but it's kind of like a self-employed business where if you stop working, the money stops coming in, right?
Absolutely.
So you decided to go into multifamily because, and you use the word legacy. Are you trying to keep the properties that you purchase forever, or just for like 5 to 7 years and then
it depends? I mean, there's a few that we've purchased that, yes, the plan is to just keep them, and then there's others that we have the 5-year projection. Depending on the market, we'll definitely sell them.
Right on, Matt. Well, you scaled really fast, because a lot of syndicators, they don't start taking down properties more than $20 million or $10 million very quickly, maybe after a decade or so. But you just recently, I think last year, took down a 1,275 unit in Houston. Is that right?
That's correct.
Yeah,
the 5 property portfolio.
I'm going off my memory because I follow you on social media. Tell us about that deal. I want to hear how did you go? I mean, was that significantly bigger than the previous project that you did?
I mean, before that, the biggest one we had done was 216 units. So
like
yes.
5 times bigger. How did you, I mean, did you just find a great deal and raise the capital for it? Was it scary? Tell me more about what made you think that you could take on such a monstrous deal.
For sure. No, I mean, it was partnerships. So, I always do a ton of networking. Before COVID, I was at every single networking event that had anything to do with multifamily real estate. And in doing that, ran into someone that was looking to another group that had over 10,000 units, and their main focus was portfolios. They had exited out of a couple, and they were looking at nothing under 800 plus units. We teamed up with them. We met their team, they met our team. We felt very comfortable. Their VP, actually turns out their VP is a good friend of mine from high school. So, I mean, it was a good fit. So as soon as we established that, our team started looking for those type of portfolios. And man, within a couple months, we found this one in Houston. The numbers were looking good, and we beat out a couple different parties, highest and best, and we actually weren't the highest offer, but they felt most comfortable with our track record and our partner's track record. So yeah, we took it down. It was a $22 million raise. Before that, I think our highest raise was maybe around 5 million. The numbers got bigger, but we were able to pull it off.
So, man, what portion of the capital raise, the 22 million, was your group Elevate in charge of? Like, how much did you guys raise on that particular deal? Was it mostly you guys, or partially you guys and then mostly the other guys?
Yeah, so we helped bring in a $10 million check. Wow. So that helped significantly. One firm that brought in 10 million. On top of that, we brought in 2 million. And then we had 2 other partners that brought in 10.
Sweet. So you mentioned a firm. So when you raised that capital, did it come from like private equity, or was it limited partners in a fund? What kind of single source was that?
It was a fund.
It was a fund.
Mm-hmm.
Was it a fund that you set up, or a fund that you brought to the table?
A fund that we brought to the table.
Nice.
Yeah.
So that's so cool.
We're looking to set up a fund now.
That's awesome. Man, that sounds like such a great deal. All right, so break down what it is that you're looking for in terms of your business model when you're selecting these deals. What is the criteria that meets your parameters and your investors' parameters for you to take something down?
Yeah, with everything that's happened with coronavirus, our criteria has changed. Mm-hmm. But so pre-COVID, we were looking for heavy value adds, mostly in sub markets. I mean, obviously Houston's a big market. DFW, we only have ownership in one property just because the prices are so high. So I mean, we were looking for good priced deals with heavy value add. This word value add has been used so loosely. So we're looking for real, where you've got at least $100 rent bumps. You've got bad property management. You've got deferred maintenance, roofs that are leaking left and right. So things that you can really come in and make a significant difference and add value to the property. As far as the cities, there's a lot of criteria a lot of data we look into to make sure that we like the population growth. We like whatever's driving that economy as far as the industries. Now, as far as looking forward, we still like the heavy value add, but the issue with those right now is the financing has gotten a lot tougher on those. We're still kind of working through that. What we're talking about is kind of going back to, let's say, DFW, the hot areas, and getting in front of those groups that may have issues now and getting to them first before it's actually listed and getting it obviously at a good price.
Quick shout out to the Capital Raiser Nation. Thanks for listening in. And please leave us a 5-star review. And quick shout out to Bakerson, who provides me with this studio. It's our multifamily investing firm. So our company, Bakerson, likes, and we agree with you in regards to value add is overplayed, right? But so we did heavy lifts. Like, we're changing our business model, but we would take down stuff that was severely distressed, that needed a heavy lift, that we had to vacate a lot of the tenants because there was prostitution or drugs or boarded up things, just environments where we had to clean them up completely. In those circumstances, right, you use bridge financing or other types of creative financing. But from your experience doing those types of deals, so when you're offering a return to your investors, are you giving them cash flow on these value add, or are you telling them, hey, like the first year while we're cleaning up the neighborhood and fixing up the property, the community itself, you need to wait? Like, what is the return structure that you guys offer? Because a lot of times you can't cash flow when the property's half vacant.
Yeah, no, we've set it up both ways. Where we are offering cash flow. And then as of late, we've just been letting the investor know, look, this is what the pro forma looks like. This is for the first year or for the first 6 months. The cash flow is not going to be there, but come year 2, the numbers are going to jump significantly. Once the refi kicks in, then it's going to jump even higher. So we've gone both scenarios. I think it's different investors. There's some that are looking for that cash flow, and then there's some that just really want good returns.
Yeah, for sure. You can typically on a value add offer a higher return, but you don't get that cash flow. So I think that's a trade-off, at least that we've experienced. Are you still specifically targeting those heavy value add properties, or so because you have to take them down with creative financing, and then after 90 days of 90% occupancy, you can refinance with Fannie Freddie? And you mentioned something very interesting too, because we're selling a property, and the people that were financing it was through COVID. The parameters changed, right? So they, all of a sudden you needed more reserves and things of that nature.
Yep.
It's been a crazy ride, but we got one that we're selling a 75 unit down in Tucson, hopefully by next week.
Nice.
So,
congrats, man.
Yeah, thanks. So in regards to what you're planning on doing in the future, are you still looking for those heavy value
Yeah.
add?
Sorry, I didn't really answer your question.
No. I kind of I rambled a little bit. And
yes, that's those are the deals we like. That's in a sense what we're built for with the construction company in-house. We feel very confident in taking on those deep value adds, heavy lifts. Yes, we're just figuring things out on the financing end. We're looking at possibly bringing in larger amounts of equity. To answer your question, yes, but now we are also shifting a little bit more and looking at more stabilized properties too, which before we really wouldn't.
Right. Real estate investing is interesting because you constantly have to be pivoting and adapting your strategy based off what the market's doing.
You have to, man. If you don't end up staying in the game. I've seen it happen.
But particularly when you're scaling, you have to shift for scaling as well, right? So you're
Mhm.
taking down bigger and bigger deals. That means you have to change up your model. So that's really cool. All right, so tell us about the raising capital side of things. That's what this show's about. I think people that are tuning in right now to hear you specific to capital raising, they want to know how you raise capital for these big projects, and if they're probably contemplating whether or not they can scale at that level themselves. I think a lot of our listener base, they're multifamily syndicators that are looking to expand and scale themselves. So do you have any words of advice there?
Yeah, I mean, our big thing has been bringing in institutional or a fund, whatever you want to call it, somebody that's going to bring in a good majority of the equity. It's a hard sector to maneuver through. I'll explain a little bit more into that. There's a lot of brokers, and sometimes you think you're speaking directly to the money or the person in control of the money, and you're not. You're speaking to a broker. We got burned a couple times with that.
Really?
They all require some money up front, and then you can negotiate things, but in the beginning we didn't realize that. So one, be careful, and then two, these relationships take time.
Yeah.
So the sooner you start building them, the better. And just one or two good relationships with some of these firms, and it can easily take you to the next level. We do also raise from private individuals as well, talking scaling and really getting up there as far as the acquisition dollars. I think that's an important piece.
Yeah, I just got done with a conversation with another podcaster, and he was kind of interested in the fact that I have the circle of syndicators, right? Because the way that he's been raising capital has been all private institution, right? Private equity types funds. And he was telling me, man, it's not any different. Like, you have a circle of syndicators. Well, I have a circle of private equity, and it takes time to build relationships. And there's an entire network of private equity guys that hang out together that know each other. It's very similar to my experience with syndicators. It's like there's
a small world for sure.
We all meet up at places like Best Ever Conference. I don't know what conferences the private institutions meet at, but I'm trying to find that out.
They're there, man. They're a lot more expensive, I'll tell you that.
Really? Okay,
Yeah.
Cool. And then do you guys work with a family office at all?
We're actually working a deal right now on an acquisition we're working on. It's not finalized, but there is a family office that we've been speaking with for a while now, and I think we're going to get them in on this deal.
So then do you have to structure your returns so that the family office gets more than the limited partners or the private equity money?
It's all negotiable. Yes and no. First term sheet they're going to send you, sure, it's going to probably have them in first place, getting their returns before anybody else. But you can negotiate all of that, and we try to keep it as even as possible. Sometimes it just depends on the deal, and for the most part, if you're giving a pref to somebody that's bringing in the $10 million check, it's not going to hurt the overall returns that much. It's just the cash flow, obviously.
Interesting. Yeah, so I had Dan Hanford on my show. You're going to be speaking at his Multifamily Investor Nation Summit here in early June. And I asked him the same kind of questions. I'm like, have you ever worked with family office? He's like, well, in our business model, it doesn't make sense. They typically don't ride along in the same investment deal, same as every other limited partner. They want preferred treatment. And then when you're dealing with these whale investors, these guys that write these big checks, they can sometimes hold the money over you, especially like when it comes down to closing. If they don't have any money on the line, they can just pull it and say, hey, we're not going to close with you, so we need to renegotiate the terms. And Dan said, you have to make sure that they have some kind of risk at stake. And even then, like, they can still back out because it's still a drop in the bucket to them. Do you have any words of advice there? When you say you got burned, was that the type of situation you're talking about?
Yes, that was partially it. And it's funny, I actually spoke about this on Dan's podcast. On the first thing you mentioned, I think they're getting a little more flexible on their terms, just because they realize what a good investment multifamily is, and if they want to deploy their funds in there, they've got to get a little more flexible. But on the other part where you're saying where they can literally just decide not to do it, day of closing, that is the scariest part. We're trying to work some stuff out where we can get them to put some funds before and put some skin in the game before the day of closing. I would definitely suggest trying to do that. If not, I mean, there is no, they have no liability. If they walk away, they walk away. There's not much you can do. And then as far as experience, yeah, we had one party in Houston walk away. It was maybe 45 days before closing, $10 million they had committed, and then they decided not to. We had to scramble. Luckily, we had a backup that had already looked at the deal and was interested, so we made it happen. So definitely have a backup and try to get some skin in the game. That would be my advice.
All right, cool. I like that. So tell me more about these networking events. You say they cost a little bit more than the best ever conferences. Where do you go and find these events? How do you plug into them? Tell us a little bit more about that.
I know we've attended at least 2 of them. There's multifamily ones that are not multifamily, sorry, family offices, specific to family office. And I think if you go to, I believe his name is Richard Wilson.
Okay, yeah.
Yeah, he promotes a bunch of them, and his firm I think hosts some. And then there's others that are just specific to LP and to institutional equity. I don't remember the associations or the name of the events. I know we were supposed to attend one that got canceled because of COVID, but
right.
Yeah, I mean, they're a little pricier, than the syndication events.
Like how much are you talking about?
I want to say it was like 25 grand.
Whoa.
Or something. And they set you up with like specific appointments when you get there with different institutional investors. And I'm not saying it's not worth it. I mean, look, like I said, you make one of those connections, it's almost, I don't want to say priceless, but I mean, it's worth more than $25,000.
Yeah.
On average, they're more like, I think maybe around $5,000 or so to attend.
Very cool. All right, so I know that you've been working on a deal. I had a lawyer on my show, Mauricio Raul, and he was talking about what you can say and what you can't say on podcasts. And if you're in a 506B, you definitely can't say things. But if you're a 506C, I know that last I checked, but you're working on an 860 unit in Oklahoma, something like that, right?
Yeah.
Is that a 506C?
It is.
Okay, cool. Awesome. So we can talk about it. Tell us about that deal. We've
been working on this for a while now. The occupancy right now is pretty low. It's been climbing. So I want to say it's above 50% now, and it's 850 units. So I mean, a lot of vacant units, but they're in great shape. The issue, or why has such a high vacancy, is because the current owner had corporate suites. He had half the property corporate suites, half your basic multifamily rentals. And when he went to go sell the property, he's decided to kill off the corporate suites and just make it multifamily. So in a sense, he's doing a lease up right now of 400 and whatever units. But he doesn't really want to. He's owned it for a long time. He's got a lot of other stuff going on, so he doesn't really want to put the work that it takes to do that big of a lease up. Seller's been great. He's been working with us through this whole crisis. We've changed, pricing. We've changed terms. We've changed a bunch of stuff. So I think we finally got it to a point where we're ready to get it closed. Raising some equity for it right now. We are set to close end of July, worst case.
How much more do you still have to raise on that deal?
If everything falls into place like it looks like it's about to, we'll probably just be short under 2 million, or around $1 million.
Very nice. So is that equity coming from limited partners, equity partnerships, private equity, or where's that mostly coming from?
All of the above.
All of the above.
I'm just kidding. No, the seller is putting in a portion of it. The GPs are putting in a good portion of it. Private individuals, and then possibly the family office.
Is the seller going to maintain some ownership in this deal when it transfers?
And that's something we're still kind of discussing.
It's possible. Creative finance. Okay, cool, man. So tell us more about this process of getting into multifamily, because you just started a few years back. You had a transition specifically from single family to, and you mentioned all the reasons why you liked it. But then once you realized that it was a good avenue to follow, what were the steps that you took to do your first syndication, for example? Like, did you have to get a lawyer? Did you find some partners? Did you co-sponsor? Did you lean on someone's track record? What was that first big deal like?
Yeah, no, those are great questions, man. You know, the first thing was getting the knowledge, obviously, and the experience. We got some coaching. We underwrote, I don't know how many deals, a crazy amount of deals. And then what really helped us get to that first deal was having a partner with a track record. You know, at that point we had our single family stuff, but I mean, there was no multifamily, at least not large multifamily track record. We also hadn't raised any equity. At least, you know, we had some private lenders on the single family, but we hadn't raised millions of dollars. So once we found a good partner, the next step was kind of, you know, we took the same philosophy for finding deals that we used for single family, which for some reason, a lot of multifamily syndicators don't do that. But we had a lot of success with that. You know, we were cold calling, we were doing mail outs, and we found our first 2 deals that way. Once you get a couple deals and you start building that track record yourself, then the deals start coming more to you. But yeah, I would say the partnership and having that track record was probably the first piece that led us to that first deal.
So break down some of those strategies that single family flippers use to find properties that you're not seeing other syndicators use that you are using.
Scrubbing data, sending mail outs, doing text messages, calling. You know, we scrub all the data from CoStar, then we take that, and we haven't been doing that so much. We're probably going to go back to it now. But like I said, you know, once you get a couple deals, and then we have brokers and people reaching out to us left and right. We've also got other investors that are looking to get started and looking for same thing I did, you know, 3 years ago. They're looking for somebody with a track record to partner with. So we have a lot of that now as well coming to us. Yeah, I mean, just the basics, man.
Very cool. So how about this, man? I'd like to, because I follow you on Instagram, and even on like your LinkedIn, you drive people back to your Instagram. Tell us about your marketing campaign. Is that something that you create? Is you have automated people or people, you know, in other countries that do that for you? Or are you just on there doing it yourself?
For a while, it was myself until I got a little burned out.
Right.
A lot of, you know, from the content creation to posting it. So now we have a VA that does most of it. I'm still doing some of my own profile things, and then
yeah, I see your walkthrough videos at your properties.
Yeah.
Those are great.
Thanks, man. Yeah, I'm gonna have a couple in the next, going back to Houston Monday and Tuesday. Yeah, so a mixture of a VA and myself. I think eventually, you know, putting in a lot of systems to get the VA to do more, and eventually probably hire more VAs.
Awesome. Tell us about your communication structure. When you get investors into your pipeline or people that you're meeting, what kind of messaging do you have? What system do you have in place to communicate with them?
So on the front end, we have active campaign. So when they come into our system, and then we use it to the fullest. You know, when we have a equity raise, we're using the deal structure in there. When we're looking for acquisitions, we're using the deal structure within active campaign as well. So that's how we stick with our follow-up. And then once you become an investor of ours, we have Syndication Pro is our investor portal, and that's how we continue to communicate with the investors.
I have this, I think it's a pamphlet or a digital description of why you should invest passively in multifamily. I think it's specifically from Elevate. Do you know which document I'm talking about?
Oh man, we've created so many.
Yeah. So who creates those? I'm curious.
It's usually myself or Carrie on our team put together the raw content, and then we'll send that over to our VA, who will make it look nice.
Wow.
Yeah.
All right, cool. Yeah, I'm thinking about writing some kind of a summary as to why you should invest passively in multifamily. And I'm looking at your model. I'm looking at like Benny Chopra's and Dan Hanford's and even Joe Fairless to see what kind of information they give to their passive investors to decide, how to vet a sponsor, why multifamily could be a really good asset class for you, and et cetera, et cetera. But I'm curious about that because I'm kind of nervous about writing that whole thing. So I'm trying to find everybody else's, how they did it. So that's cool. I appreciate that. All right, man.
That's always smart, man. Grab as much content as you can and then, put your own spin on it for sure.
Right. All right, let's jump into the lightning round. So I'm going to put some music in the background and just ask you a set of questions here. They're mostly non-real estate related just to see how you answer.
Okay.
Try to keep your answers a little short. Tell me about your favorite vacation that you've ever taken.
Oh, man. I don't go on vacation. No, I'm just kidding. But the last 5 years, it's been mostly Disney World with three little girls. Definitely want to go to, we're supposed to have a trip to Bahamas, but that got put off because of COVID.
Okay, cool. Tell me your favorite personal development book.
Oh, personal development book. I don't know if this is, I guess it's personal development, but Can't Hurt Me is just one of my favorite, man. I don't know if
heard
you
of that one. I'm not familiar with that one. I do a lot of personal development. Who's the author? Do you know?
It's an amazing story. I can't remember the author's exact name. The guy's goes through so much in his life, and just he pushes what your mind can handle to like the next level. When I think something's hard, I always kind of think back to that. I'm like, okay, no, it could be harder.
Awesome. Tell me the favorite real estate deal that you've ever been involved with.
Man, it would have to be the 1,200 units as of right now. That one.
All right. Have you ever experienced a miracle or had a near-death experience?
Near death, no. Miracle, I would say, having my firstborn felt like a miracle.
Yeah.
We had issues getting there, so yeah.
Yeah, I think a lot of people don't even realize that. Like, I've asked a lot of people if they've ever experienced a miracle, and they don't usually say their kids, which I would think is the first one, right? Because just to have a life come into this world, that's a miracle for me. All right, favorite aspect of multifamily investing?
The people. Everybody involved throughout the entire transaction, from other investors, from our limited partner investors to other general partners to the vendors. Everybody's just overall nice.
Very cool. And then how about this? Your favorite childhood memory?
Damn, you got me good on that one, man. Making me think back.
Right.
I'd have to say some type of family vacation. We would go to Marco Island in Florida, and that was always a great trip.
Very cool. All right. So where do you want to travel to that you've never been, not including, I think you said you're going to the Bahamas later. Where else would you like to go?
Greek islands.
Oh, that would be sick.
Yeah.
Something like that. All right. So I've never been, but that's on my bucket list too. All right. Spiritual philosophy in 20 seconds. And then I got one more after that.
Spiritual philosophy.
I would say like the golden rule, man. Do unto others as you want done to yourself. And like, I believe in karma and stuff. So if you're not doing things that are in alignment with your higher power, whatever that is, that's why you can't attract certain things into your life. At least that's mine in 20 seconds or less.
Yeah. I guess, same thing I try to teach my children is just, have those good morals and kind of like what you said, just don't do to others what you wouldn't want done to yourself. And, a lot of people have been successful in life and they've done some pretty bad stuff to get there.
Yeah.
That's not worth it.
Right.
Get there the right way.
I love that. All right. So last question, how long do you want to live?
I would love to see my grandchildren, spend a lot of time with my grandchildren. So, I would hope by then I've done a good job of building that legacy and that generational wealth. And, I can just spend a lot of time with my kids and my grandkids.
Woo, awesome, dude. I love those answers. That was cool, dude. I love catching you off guard, making you think, dude. That was fun. let's wrap up with a couple of things. I'm curious about your partnership. It's Elevate, which is your company, and then you got some other partners. Who all do you work with?
And we've partnered with a lot of different general partners on all our deals. We've done some deals with Tim Bratz, which I'm sure most of your audience has heard of. We've done possibly a second deal now with Zadik Management, which is a pretty large company, and then a couple other different partners. I mean, we're always open to doing a co-GP. That's part of how we've been able to scale. So, and then within Elevate, there's a team of us. There's 4 of us within Elevate itself.
All right. So, what is your general responsibility within Elevate? Are you primarily investor relations? What all kinds of stuff do you do?
Primarily the visionary type. CEO is the title that we use. I kind of just make sure that we're heading in the right direction, and then step in on the day-to-day stuff when I need to. Raising equity. I definitely want to oversee the acquisitions. Like when it gets to a certain point, then I want to review it, make sure it lines up with what we want to be acquiring.
Right on, man. All right. So for the Capital Raiser Nation, how do they get a hold of you, man?
Couple ways. If you go to our website, which is Elevate CIG, that stands for Commercial Investment Group .com. You got a bunch of resources on there. We've got a free ebook that goes over all the benefits of investing in multifamily. And then if your listeners want to go ahead and email me, it's Jorge, Jorge @elevatecig.com, and I can go ahead and send them some free content. I've got a checklist for due diligence. I've got questions you want to ask your sponsor before you invest in a deal, and some other things that I can send them.
All right, cool. And then follow George at George Multifamily. That's his handle on Instagram. That's a great place to check him out. Got great content. All right, cool, man. Well, that's about all I got for today, dude. You've been rad. I loved having you on the show. It's been a lot of fun. And I hope to bump into you at one of these events and possibly maybe invest with you guys down the road. Who knows? Maybe some co-GP opportunities will arise and we'll work out. So we'll definitely stay in touch, brother. It's been great having you on.
No, it's been fun, man. Thank you.
All right, cool, man. Enjoy the rest of your day.
Bye.